We all know that a rising gold price indicates a failing fiat currency. Open your eyes. The currency is failing. Look at the purchasing power charts, which I didn't put in here, but I've shown you a million times. It's my favorite chart. It's going to zero, just like over 4,800. Look, there's over 4,800 currencies that do not exist anymore, including the gold certificate, the silver certificate, Central Bank of Iran, right? This is nothing. The government says this is money. Guess what? They can also say it's no longer money, but the markets can also say it by design. They're designed to go to zero.
The escalation of borrowing costs and the obligations associated with debt payments are fostering an increase in defaults. Stricter lending conditions press businesses towards insolvency, exerting an influence on multiple financial markets, including gold. Recent gold prices have exhibited an upward trajectory, with values hovering around $1,920 per troy ounce. Lynette Zang, chief market analyst at ITM Trading, suggests that the ascent in gold prices indicates growing concerns among the populace regarding the erosion of value in their fiat currencies, notably the US dollar. Government debt can lead to inflation when they print money or boost spending, reducing currency's value. In response, investors often use gold as an inflation hedge. For instance, in 1970, the U.S. national debt stood at $372,007, and the price of gold was $35 per ounce. Fast forward to 2023, and the national debt has soared to $31,457,820, while the price of gold has reached $1,982 per ounce. Lynette's perspective underscores the concept that the price of gold tends to go up when people are worried about the value of their regular money decreasing due to factors like government debt and the creation of new money. Before you watch Lynette Zang's interview and the latest market trends, subscribe to our channel and give this video a big thumbs up. The US dollar has dramatically depreciated. For instance, $1 in 1800 is now worth about $22.13. In 1913, it was worth less than 4 cents. MoneyWise notes a 98% loss in purchasing power since 1971. Gold has proven to be a stable store of value, highlighting its role as a hedge against currency depreciation due to government policies and excessive borrowing.
When you look at the spot gold market and how that keeps pace with the rising U.S. debt, this gold line is the spot market. This goes back to 1970 and takes us through 2023. And you can see that once people realize it and once that cup formation is fully broken, it goes up to new levels. But this is the manipulated spot market. It doesn't really reflect what's happening in the physical only market. And I've shown you those graphs a million times, and we'll probably show you a million more so that you know the truth. But physical gold in your possession, this is my savings. Right? There's no debt attached to this. There's no counterparty risk attached to this. What's this stuff? It's debt. It is a Federal Reserve note. A note is a debt instrument. It's borrowed into existence. Its value, its purchasing power value, I think I'm done, but its purchasing power value has been reduced via all this debt. Because every time they create new money, the value of what's already out there is lost. So what are you going to do about it? The markets are schizophrenic. One day they like what's happening, so woo, there's euphoria. Markets are up at all new time highs, high PEs, etc. But then the reality sets in, and then they try and dump, and then they got to keep them supported again. Because what do people do? They open up their 401k statement or their IRA statement and they go, oh, okay, things must be okay as long as the stock market is okay, or as long as the bond market isn't too terribly bad. But look at all of these industries. Oops, let me grab a laser pointer. Look at all of these industries with the most distressed debt. That means they're already having trouble paying their debt. Other, which they're not specific about here, is the largest area. real estate, telecommunications, retail, software and services, healthcare, and pharma. There is a lot of corporate debt that is in deep, deep doo-doo. At the end of the week, marked by optimism, the Fed would be closer to ending its interest rate hikes. And aren't they coming out and talking about, well, the Fed's at the end of the road, probably at the end of the road. Maybe we'll get one more. Maybe we won't. Maybe it'll be a soft landing. Hey, maybe we'll avoid recession. That is such garbage. Look at this. Don't believe their lies anymore. Because how many times can you be lied to when you do not know the truth? Every single flipping time. The uncertain scale of the lagged effect of prior interest rate hikes means that both recession and a Federal Reserve policy error remain potential risks. Yeah, think? Because I definitely do think that that is what we're seeing. So how do you think if they are going to fight the inflation that they created, sorry, Randy, fight the inflation that they created, how are they doing that? By raising the interest rates. I personally think we're going to see a pivot at some point, but I can't tell you when. Is there going to be another rate raise? Well, yeah, they're trying to get back their credibility. Remember when they gave it up last June? A year ago last June? I was amazed that they were so stupid to give it up. But give it up they did. Now they're fighting back for their credibility, and that creates a danger.
Lynette highlights that banks are tightening their lending practices, affecting businesses and individuals. This situation resembles the lead-up to economic recessions, but government actions have postponed the downturn so far. According to the Federal Reserve's Senior Loan Officer Survey for the second quarter, lending standards across all loan categories have become more stringent since 2022. Banks attribute this to rising U.S. interest rates, concerns about a potential recession, and the recent failures of several regional banks in the spring. The tightening of lending standards and reduced loan demand may enhance the appeal of precious metals like gold and silver as alternative safe haven investments amid economic uncertainty and banking vulnerabilities. Now, let's move towards the interview.
Banks say conditions for loans to businesses and consumers will keep getting tougher. What does that look like? Well, this is from the Fed, the Federal Reserve Education Department, and this is the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. So this is very similar to what's also happening with smaller firms. So here's your businesses, and it's tight. And you can see quite interestingly that when it got tight in the past, was with these gray bars, which are official recessions. Now we're up at those levels and no recession. Why? Because of all of the money printing that they did. All that did is push it off or push the appearance of it off because not everybody is in the same boat. But it's also for consumers as well. So let's see what that looks like. This is net percentage of domestic banks tightening standards for credit card loans. Just as one example. And so you can see that that too is tightening. So you got to ask yourself, is the party over? Wall Street new zombies may well be regional banks. Commercial real estate exposure is a growing concern for lenders. But are they the only ones? I don't know. Let's take a look, see what they say. This is the volume of maturing commercial property loans by lender starting in 2023, so this year. And it's from all of the different lenders. Let's just look. This one goes through 2027, so over the next 4.5 years. And it includes CLOs, collateralized loan obligations, which the Bank for International Settlements have talked about. But all of these commercial mortgage-backed securities, investor-driven, private government agency insurance. So these are all the entities that invest in commercial property loans that are maturing, that you buy these products. And they're put in your IRAs, your pensions. It's those institutional investors that invest your money. That's your skin in the game, not theirs. They're just making money from it. And then the last three, International Bank, which is this dark blue, the medium blue is the national bank, and then the light blue are the regional banks. So I just kind of singled those out because one of the things that I want to point out to you is that while, absolutely 100%, the regional banks are very exposed, and that creates some problems too because they're not lending. It's getting tighter, but it's getting tighter in the entire banking sector. And you can see how much exposure in these are national banks. So these are even your large banks. So when they talk about what happened at SVB or First Republic, right, with the interest rates, right? Interest rates go up, the principal value, the market value of the bonds go down. And they want you to think that it was only in those few banks and this is just a kind of unique. It's not. It's throughout the entire banking sector. So what's going to happen if they're not going to roll these loans over? Well, what we are going to see here is that it is getting a lot tighter. This is the net percentage of domestic banks that are tightening standards for commercial real estate loans that are secured by non-farm, non-residential structures. So are you going to be impacted by it? Maybe. And I say that because this maturing debt is not likely to be, most of it is not likely to be rolled over. So that means that you're going to have rising defaults.
Lynette also draws attention to a chart displaying the volume of commercial property loans maturing from 2023 to 2027. She warns that regional and national banks are becoming more cautious about extending loans for commercial real estate projects. These tighter lending standards coincide with decreased loan demand, particularly among home buyers and large businesses with significant projects. Since the sudden failure of two regional U.S. banks, Silicon Valley Bank and Signature Bank, in March, investors have expressed concerns about the vulnerabilities of regional banks' balance sheets, particularly their exposure to the commercial real estate sector. In light of these economic trends and the role of gold as a hedge against currency depreciation and economic uncertainties, how do you perceive the current economic landscape and the potential impact on traditional investments like currencies and gold? Share your thoughts in the comment section. If the video resonated with you, make sure to join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 80% of our viewers haven't subscribed yet. We aim to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.